Because before regulators allow you to handle other people's money, they want to know one thing: what happens when your business loses money. If a restaurant loses money, the owner absorbs the loss. But a bank is different. When a bank loses money, the consequences can spread far beyond the people who own it. A bank is connected to depositors, borrowers, other banks, businesses, and potentially the entire financial system. That is why regulators take bank failures so seriously. So regulators want the owners to have something called capital. Think of capital as the financial cushion that stands between ordinary losses and disaster. And this is one of the biggest misunderstandings about banking. Deposits are not the bank's capital. Your checking account balance is money the bank owes you. Capital is different. It belongs to the owners, and it is designed to absorb losses when things go wrong. Imagine you deposit $10,000. From your perspective, that money is still yours, but on the bank's balance sheet, it is a liability. The bank now has access to that funding, but it also has an obligation to return your money when you ask for it. The bank can use its funding to make mortgages, business loans, auto loans, and other investments that generate income. Over time, a relatively small amount of owner capital can support a much larger financial balance sheet. This is called leverage. Imagine a bank eventually has $200 million of funding. That money can support a much larger portfolio of loans and investments than the owners originally put in. But the bank cannot simply lend every dollar. It needs liquidity, regulatory capital, and enough flexibility to handle withdrawals and unexpected problems. Once the bank makes loans, those loans begin generating interest income. That interest is one of the primary ways the bank makes money. Borrowers pay interest to the bank, while the bank pays interest to depositors. The difference between those two flows is a major part of the bank's business model, but that difference is not guaranteed. When interest rates change, the cost of deposits and the income from loans can move at very different speeds. When rates rise, customers start looking for better returns on their savings. They can move their money to another bank, offering a higher interest rate. That means the bank may suddenly have to pay much more to keep the deposits it depends on for funding. But many loans, especially fixed-rate mortgages, cannot simply change their interest rate every time the market moves. So the bank can end up paying more for its funding while earning almost the same amount from its existing loans. This is interest rate risk. The bank is connecting short-term deposits with long-term assets, and that difference in timing can become extremely dangerous. Now imagine something even worse. Customers suddenly become nervous and start asking for their money back. On a normal day, deposits flow into the bank while other customers withdraw money. The system works because these flows generally balance each other. But if too many customers withdraw at the same time, the bank's available cash can disappear very quickly. The bank then has to find liquidity. It may borrow money, sell assets, or look for emergency funding. And selling assets quickly can create another problem. The bank may have to sell investments before it originally planned to. If market prices have fallen, those assets may be worth much less than they were when the bank bought them. This reveals an important distinction. A bank can be profitable on paper and still have a serious liquidity problem. And now we reach the other major risk in banking loans. Giving someone a loan sounds simple, but the entire business depends on one assumption: that the borrower will eventually pay the money back. That is why banks lend to many different types of customers, from homeowners and car buyers to small businesses and large corporations. Before approving a loan, a bank officer has to make a prediction about the borrower's future ability to repay. They examine income, expenses, employment, and cash flow to determine whether the borrower can realistically handle the payments. They also examine credit history, looking for evidence of how the borrower handled debt in the past. And when necessary, they look at collateral, such as a house, a car, or business property that could help protect the bank if the borrower defaults. Ultimately, every loan is a prediction about the future. The bank is betting that the borrower's financial situation will remain strong enough to repay. but nobody can predict the future perfectly. Economic conditions can change, businesses can fail, and borrowers can suddenly lose their income. Now imagine your bank has built a $1 billion loan portfolio. It sounds enormous, but even a small percentage of losses can become significant. If just 1% of those loans becomes unrecoverable, that represents $10 million in losses. And those losses come directly against the financial cushion that protects the bank's owners and creditors. During a recession, the problem can become much larger. Businesses struggle, unemployment rises, property values fall, and more borrowers begin missing payments. Suddenly, the bank is dealing with hundreds or thousands of overdue loans at the same time. That is why banks set money aside for potential credit losses. They try to prepare for bad outcomes before those losses actually arrive. These reserves are based on estimates of expected losses. But estimates can be wrong, especially when the economy changes quickly. During good economic times, everything can look incredibly safe. Businesses are growing, property prices are rising, and borrowers are making their payments. And that creates a powerful temptation to grow faster. Competition makes this even stronger. If another bank offers bigger loans or better rates, customers may leave unless you respond. Banks can gradually loosen their lending standards, approve more loans, and accept more risk in exchange for faster growth. During the boom, this can look brilliant. Loans increase, profits rise, and the bank appears more successful every year. But eventually, the economic cycle can turn. Rising profits become falling profits, and the risks that were invisible during the boom suddenly become obvious. That is when you discover which banks were actually managing risk, and which banks were simply benefiting from good conditions. Strong banks also try to diversify their sources of income. Lending is important, but it is not the only way a modern bank makes money. Banks can provide wealth management services, helping customers invest their money while collecting fees for managing those assets. They can also earn revenue from payment services every time customers use bank cards and financial networks. Large banks can even operate investment banking businesses, helping corporations raise money, complete mergers, and access financial markets. Diversification can make a bank more resilient, but it also makes the organization much more complicated to operate. And complexity creates another enormous expense: compliance. Banks have to monitor transactions, detect suspicious activity, protect customers, and make sure their operations follow thousands of financial rules. They also have to defend themselves against cyber attacks. A modern bank is a massive target because so much money and personal information flows through its systems. And all of that technology is expensive. Banks spend enormous amounts of money on servers, software, cybersecurity, engineers, and digital infrastructure. In fact, the modern bank increasingly looks less like a traditional building and more like a technology company wrapped around a financial balance sheet. Traditional branches create another layer of costs: rent, employees, security, maintenance, utilities, and cash handling all add up. And customers are increasingly doing routine banking through their phones instead of visiting a branch. But digital banking is not free. The branch may disappear, but the technology, cybersecurity, servers, and engineers still have to be paid for. Then comes another interest rate shock. Rates rise sharply, depositors demand higher returns, and the bank's carefully balanced economics begin to change. This can create a dangerous feedback loop. Customers become nervous, deposits leave, the bank sells assets, losses appear, capital falls, and even more customers become nervous. This is why capital and liquidity are not the same thing. Capital protects the bank against losses, while liquidity helps it meet immediate cash demands. A healthy bank needs both. Having plenty of capital does not automatically solve a liquidity crisis, and having plenty of cash does not eliminate long-term losses. The strongest banks are designed to survive difficult periods, not just make money when the economy is booming. And when everything works correctly, leverage can create extraordinary returns. A relatively small amount of owner capital can support a much larger portfolio of income-producing assets. But leverage works both ways. The same structure that magnifies profits can magnify losses. If the assets lose value while the equity base remains relatively small, even a modest percentage decline can destroy a large portion of shareholder capital. So what does a strong bank actually need? Stable funding, good borrowers, diversified assets, careful interest rate management, strong liquidity, sufficient capital, and efficient technology. And perhaps most importantly, it needs discipline. The fastest-growing bank is not always the strongest bank. During a boom, everyone wants to chase the same profits, but the disciplined bank knows when to stop taking additional risk, even when competitors are getting richer. That discipline can allow a bank to build something incredibly valuable over decades' trust. But trust is also fragile. A bank can spend 20 years building a reputation, and customers can begin questioning it in a matter of hours. And that is the real economics of owning a bank. You are not simply buying a vault or an interest income machine. You are managing leverage, liquidity, risk, and confidence. Because in banking, the biggest asset on the balance sheet isn't the building, the loans, or even the cash. It is trust.